Well, the key takeaway from the Credit Suisse report is that it is not the time to buy yet. And I quote now, wherein the report says that we remain confident of upgrades to India's economic outlook and at some point would be buyers, but not yet. And the reason simply is that even though we have seen a bit of a correction in the Indian markets as compared to the global peers, we have performed much better. Now, the report points out, for instance, how Indian markets have slipped 2% in USD terms in January 2022, but we have still outperformed the global peers by 3.5%. And as a result to that, the premium that India commands to the world has remained elevated at 33%. In fact, it is at close to a 10-year high range that we have seen as far as the premium to the world is concerned. Now, in terms of the stock moves, they did point out that 24% of the Nifty stocks are trading more than 20% of the 52-week high level. And if you look at the broader markets, this percentage is much higher at 44%. But history tells us that in a time of a downtrend in the market, this ratio can become much higher. So they see that bit of room for the downside for expensive stocks. And they talk about how in a scenario when the US inflation is higher, the P for Indian markets remain capped, or there is a likely scenario for the markets to fall, which means that P multiples may fall faster than a rise in 12-month forward earnings, pressuring the markets till earnings catch up. And that is why they have screened the stocks which are expensive. They have a neutral or underperformed rating on these stocks, and they believe that they are still at a one standard deviation higher than the 10-year mean. I'll just read out some of the names from the list. Names like Pidilite, Wipro, Titan, Voltas, Page Industries, Reliance, Escorts, Kotak Mahindra, Jubilant Food, which has been under pressure, Hindustan Zinc, Dixon Tech, just to name a few, are the stocks they have underperformed or neutral on and say are trading at expensive valuations.